we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. Frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense.
Are you tired of hearing the same old Warren Buffett investment advice? Want to learn about an innovative investment strategy that could revolutionize your portfolio? In this video, we'll dive into the fascinating world of factor investing and answer the question on everyone's mind. Is it genius or the greatest scam in investing history? We'll explore what factor investing is, its history, and the 5 main factors, and ultimately determine if it's a game changer or a fraud. So, grab a seat and get ready for an engaging and thought-provoking discussion. The concept of factor investing is not new. It originated in the 1960s with the capital asset pricing model. This model suggests that a stock's expected return is based on its correlation to the larger stock market. However, it wasn't until the 1970s that factor investing truly came into its own with the efficient market hypothesis. This hypothesis proposed that market prices were fair because all investors had access to the same information, reacted instantaneously, and acted rationally. However, there's often a disparity in access to information and irrational behavior, leading to inefficient markets. Factor investing provides a solution to this problem by using specific factors to predict stock performance. In 2009, the evaluation of active management of the Norwegian government pension fund, Global Report gave factor investing a significant breakthrough. The report aimed to explain the drop in the performance of wealth funds during the 2008 financial crisis. Nowadays, more and more investors are using factor investing as a strategy to make more informed and systematic decisions about their portfolios. Investors can identify stocks with higher expected returns and reduce their overall risk by analyzing specific factors. There are 5 primary factors that financial researchers have identified as driving long-term stock returns: value, size, momentum, quality, and low volatility. In this video, we'll explore each of these factors in depth, examining how they work and whether they're reliable indicators of stock performance. Most importantly, we'll answer the question on everyone's mind on whether factor investing is the greatest scam in investing history, or is it a legitimate and innovative approach to investing? Let's take a look at the 5 investing factors. 1. Value. Have you ever heard the saying, buy low, sell high? Well, that's exactly what the value factor in factor investing is all about. The value factor focuses on investing in companies that the market has undervalued, believing that these companies will eventually appreciate their true worth. To identify undervalued companies, investors look at various fundamental metrics such as price-to-book value ratio, price-to-earnings ratio, dividends, and free cash flow. If a company's stock price is trading lower than its intrinsic value based on these metrics, it is considered a value stock. Value investing has a long history of success, with famous investors like Benjamin Graham and Warren Buffett being known for using this approach to achieve great returns. Research also suggests that over the long term, value stocks tend to outperform growth stocks, which are those with high valuations relative to their current earnings. So, the value factor is an important tool for investors to identify undervalued companies and potentially achieve higher returns over the long term. Investors can take advantage of market inefficiencies and build a resilient investment portfolio by looking beyond the current stock price and examining a company's underlying fundamentals. 2. Size. This factor is based on the premise that smaller companies outperform larger ones over the long run. This is because analysts and institutional investors often overlook small-cap companies, resulting in their stock prices not fully reflecting their growth potential. In factor investing, the company's size is also an important consideration for investors. Small-cap companies are considered those with a market capitalization of up to $2 billion and have been found to outperform large-cap stocks. Another interesting observation is that bonds issued by companies with little debt outstanding and small capitalization stocks tend to outperform the market. While investing in small-cap companies can generate higher returns over time, it also comes with higher risk due to their vulnerability to economic downturns and market shocks. However, for investors with a long-term investment horizon and a risk tolerance, the size factor can be a powerful way to generate outsized returns. Investors are inclined to include small companies with high growth because small-cap stocks historically provide higher earnings than large-cap stocks. 3. Momentum. The momentum style factor is an investment strategy focusing on stocks already showing significant positive performance. The basic premise of this factor is that stocks that have performed well in the past are more likely to continue performing well in the near future. In practice, a momentum investing strategy looks at a stock's short-term returns over a period of 3 months to 1 year. Stocks that have outperformed in the past are likely to exhibit strong returns going forward and may continue to experience upward price trends in the future, making them attractive to investors. In addition to considering past performance, momentum investors also look at other factors such as trading volume, price volatility, and analyst recommendations to identify stocks likely to continue performing well soon. They may also use technical analysis tools such as moving averages and relative strength indicators to help identify trends and entry-exit points. One of the key advantages of momentum investing is that it can provide a way to capture market trends and generate higher returns in a relatively short period of time. However, this approach can also be risky as it relies on unpredictable short-term market movements that are subject to sudden reversals. 4. Quality. Investors always look for stocks that promise high returns with minimal risk. That's where the quality factor comes in. It's all about investing in financially healthy companies that have strong balance sheets, consistent earnings growth, and stable cash flows. To measure quality, investors use financial ratios like return on equity, debt-to-equity ratio, and interest coverage ratio. Companies with high return on equity and low debt levels are generally seen as better investments for the long term. Studies have shown that the quality factor outperforms the broader market over time, making it a popular choice for investors looking for stable and resilient stocks. But it's important to remember that high-quality stocks can be more expensive than other options and may not always perform well in every market condition. When choosing quality stocks, investors should focus on companies with low debt-to-value ratios, high return on assets, and return on equity. These companies tend to have stable earnings, consistent asset growth, and strong corporate governance. 5. Volatility. When it comes to investing, the volatility factor is a crucial element to consider. Volatility measures how much a stock or portfolio's value fluctuates over time, which can significantly impact both risk and return. High volatility stocks and portfolios can experience drastic gains or losses quickly, while low volatility stocks and portfolios offer more stable, predictable returns. Investors who prioritize the volatility factor may opt for low volatility stocks and portfolios that historically show less volatility than the broader market. While these investments may be less risky and more stable, they also offer slower growth than high volatility investments. To build a well-diversified portfolio tailored to their investment goals and risk tolerance, investors may use the volatility factor in combination with other factors such as value or momentum. By incorporating multiple factors, investors can minimize their exposure to specific risks and increase their chances of achieving long-term investment success. While factor investing offers many benefits, there are also some drawbacks that investors should be aware of. One potential disadvantage is that by focusing on a single factor, investors may be exposing themselves to additional risks rather than diversifying their portfolios. For example, if an investor heavily invests in small-cap stocks using the size factor, they may be taking on the risk associated with investing in small, high-growth companies. This could lead to higher volatility and potential losses. Another issue is that overeager investors may become too fixated on certain factors and miss out on a well-diversified portfolio. It's important for investors to consider multiple factors and create a balanced portfolio that aligns with their investment goals and risk tolerance. Moreover, smart beta funds that utilize factor investing strategies may need to be rebalanced frequently. This is because a stock may no longer fulfill a certain factor, requiring it to be sold and replaced with a stock that meets the factor criteria. This frequent rebalancing can lead to higher transaction costs and potentially lower returns. Overall, While factor investing has proven to be an effective investment strategy, investors must carefully consider the potential drawbacks before implementing them in their portfolios. It's important to have a well-rounded approach that considers multiple factors and aligns with their investment objectives. In conclusion, factor investing can be a powerful tool for investors seeking long-term success. However, it is important to look at the potential risks and downsides associated with this investment strategy, such as concentration risk and potential performance-chasing behavior. Investors should also be aware of the additional work involved in selecting and managing factors, compared to buying a single ETF without specific factor exposure.
I can't think of a single example in my whole life where keeping it simple has worked against us. We've made mistakes. We've tried to give power to very talented people and let them make very quick decisions.
There are also ETFs that include multiple factors, like the iShares Edge MSCI World Multi-Factor ETF. But this fund, for example, also earned significantly lower returns than its non-factor counterpart since its inception in 2015. If you're interested in learning more about factor investing and staying up to date on the latest investment trends, be sure to subscribe to Ape Finance and hit the notification bell to get updates on our latest videos. Thanks for watching, and we'll see you in the next one.